Welcome to episode 10 of the Cash Flow Connections podcast. This is really a special episode for many reasons. First of all, our guest has an incredibly proficient background in the industry, as you will see from the introduction, but also the content is just really interesting, educational, and quite entertaining. In the episode, we discuss the commercial and residential lending environment, the future of interest rates, the potential for even negative interest rates, and how the political landscape can play a huge role in the investment space. This is definitely one of my favorite episodes. In fact, I had to edit out a few laughs and chuckles on my part because the comments the guest ends up making are really quite remarkable given the gravity of his statements as well as his track record in the industry. It's really something special. Now, before we get into the episode, I want to remind you that we just recently finished our self-storage ebook. If you haven't yet read the ebook, make sure to do this thing. Go to the iTunes library, find our podcast, which is Cash Flow Connections Real Estate Podcast. Give us a review, screenshot the review, and send me a picture of the screenshot to hunterthompson@cashflowconnections.com. Once you do that, I will shoot you over a free copy of this ebook. It takes about an hour to read, and it's really educational. It's right to the point, and I think you're going to learn a lot. Now, without further ado, we'll go ahead and get straight to the interview. How's it going, everyone? Today, our guest is Ethen Penner, who's the founder and managing partner of MREC Management, LLC. He's a recognized pioneer in the fields of real estate and finance with a 35-year career marked by filling voids and responding to unseen or poorly understood opportunities. Most consequently, he is credited with being the primary driver in the creation of the commercial mortgage-backed securities market. In 2011, Real Estate Forum voted him one of real estate industry's 65 living legends in their 65th anniversary issue. In 2008, Penner founded and served as president of CBRE Capital Partners, which is a real estate debt investment platform that successfully raised and managed over $600 million from institutional and high net worth individuals. Ethen continues to better the lives of the people around him in many ways. One of that ways is teaching at USC, and he also writes a blog, which I will make sure to link in the show notes page. So Ethen, tremendous thanks for coming on the program. Very excited for this conversation.
It's a pleasure to be with you today. Thanks.
So there's a million questions I want to ask, but let's really start with what you've got going on at Mosaic. Tell us a little bit about Mosaic and what it is and what you saw happening in the market that created the opportunity for Mosaic to be successful.
Well, as you mentioned at the outset, what my kind of entrepreneur's ethos starts with asking the question, what's needed in my world that is not being provided, right? What void exists or what need is not being met? And then going out and seeing if I could fill that void. And so that's really the foundation of what Mosaic was intended to be. And I think I can proudly say that after being operational for 2 years, we've achieved a modicum of success that seems to validate that we're on the right path. There are a couple of voids that we have set out to fill. The first, which is kind of the essence of our business, is we originate loans to developers around the United States who used to be able to borrow from banks, but for whom banks are not there today for the most part. And so with the retrenchment of banks from the business of development and construction finance, that's created an unmet need, and we fulfill that need. So we provide typically non-recourse first mortgage finance to the real estate industry nationally. We make loans that range in size from the smallest probably is around 10 or 15 million to so far the highest has been just under 100 million. And we get paid very well for what we do. And I think that reflects a combination of the unique value that we present for the borrower, both the availability, absolute availability of capital that's hard to find today, the fact that we're very responsive and non-bureaucratic, and we are reliable. And so we have found a niche that is not heavily competitive in an investment world that is extraordinarily competitive, and that has allowed us to earn returns for our investors that are far better than I think most of the investment world is enjoying today. Yeah, I'd say the other unmet need that I think we have fulfilled very nicely is for investors beyond just delivering a very nice contractual yield at what I would consider a very moderate risk. The other very interesting thing that we observed and that we've been able to provide our investors with is a really exciting alliance of interest between the manager, ourselves, and our investors. And the foundation of that has to do with our fee structure. So we don't charge management fees. We only charge our investors incentive compensation, which means we don't get paid a dollar other than as a percentage of the income we generate for our investors. If we don't produce, we don't get paid. If we don't get paid, we lose money coming to work. And I think that alignment of interest, it's healthy, it's called for. I think it's a breath of fresh air, and our investors have greatly appreciated it.
Makes total sense. Incentives are always going to determine actions over the long term, especially, and creating that structure really further solidifies that alignment. So, do you guys lend on exclusively commercial deals? I'm assuming it's commercial exclusively, just given the price point. But are you guys considering residential as well?
No, I would say that residential has been an important part of our business, and we've done an interesting array of residential. So we have made loans on New York City single property conversions, where we have a borrower who has a business of buying. He hasn't been doing much of it lately, but when we funded him a couple of years ago, he was busy of buying brownstone properties and gut renovating them and converting them from multi-tenant properties back into their original single-family use and selling them to high-end residential buyers. So we've done a few of those. We've also done some entitled land financing that I call pre-development financing, where someone has optioned land, gotten the entitlements during that process, and the entitlements for multifamily product, and we finance the takedown of the land. And in that case, we might or might not finance the ground-up construction on that multifamily project that I'm referencing now, but we were in that game. We've done a few, actually three, if my memory serves me right, high-end residential second home community deals. One in Hawaii on the island of Kauai, one in Kiowa Island, South Carolina, and one on the shores of South Lake Tahoe. So residential has been an interesting and important part of our business. We actually also did a ground-up land takedown and construction financing for a extremely high-end spec development deal on a single-family home in Bel Air. So we've done some residential. We don't finance owner-users. So like an owner-occupant, we're not in the consumer lending business.
Got it. And so you mentioned the financing on the land. We had someone talk about land entitlement recently. So I'm kind of curious there. What typically do you look for in terms of loan to value in a land entitlement type of transaction?
Yeah, we don't finance unentitled land. So
Okay.
to be clear on that, that's not a game we're in. As far as entitled land goes, we have one or two hard limitations, and other than that, I would say we have just a prudent percent approach to our business underwriting. Our hard and fast limitations are 70% loan to value and 5-year absolute final maturity. Those are the two hard and fast limitations that we operate within for our fund, for this particular fund that we're operating.
Okay, got it. And so when you say loan to value, I'm assuming that is an after repaired value in some perspective. So is that correct, first of all, before I go forward?
I think that we have the latitude to be prudent in how that we deal with that, meaning it's clearly not a loan to cost limitation. It's a loan to value limitation.
Right. Okay, that makes sense. And so, loan to value is definitely one of these type of topics, but from a deal structure perspective, you also mentioned the incentive alignment and the after repaired value maximum. What other type of structures do you implement to protect your investor capital in the event that, let's say, a borrower fails to effectively execute the original development plan or something like that?
Well, I take um, a personal role in being pretty deeply involved in the legal documentation process on all of our deals, and it's with an understanding that things don't always go right, and while we root for and we expect our borrowers to succeed and to execute their business plan according to their plan, it's our fiduciary responsibility to our investors to have the oversight in place and to have the authority by virtue of the loan documentation to remedy situations when things go off the rails. And so we have all the necessary kind of control provisions that you might imagine give us comfort that if things go even a little bit off the rail, we have remedies available to us. And I think reputation means so much, right? So there's a self-fulfilling nature to, I think, business success. If you have a reputation for being fair-minded, for not being an opportunist that just takes advantage of people, then you get the best deals, right? The best borrowers that have the best deals, that are willing to put in significant equity to support those deals, are going to have some choice, even in a market for which there's not a lot of debt. They're going to have some choice as to who they go to, and you want those people coming to you. And so, if you have a reputation for being protective of your investors but still reasonable and fair-minded, you're going to get those deals. And if you have a reputation for being a quick trigger puller who is going to undermine the success of the borrower, then and look to perhaps even take advantage of them when they trip, which happens in deals, then you're not going to get the best deals. And so I think that, having been in this business for a long, long time, I'd like to believe that I have the reputation for the former, and that accrues benefit to our investors.
Absolutely. Makes total sense from both a real estate perspective and from a business perspective. So you're obviously in the lending game. Let's talk a little bit about interest rates. It's been a very hot topic of discussion amongst real estate investors, Wall Street, Main Street. Everyone has been talking about this. So what are some of your thoughts on the current interest rate environment, and where are you expecting rates to go, let's say the next 2 to 4 years?
Well, interest rates are the single most important thing in determining value of all financial assets. And I think it's very important for any investor in the world, no matter what their investment strategy is, to understand that simple fact. Interest rates are the mathematical driver of value. I feel very, I would say, optimistic, if you will, about rates. I've been a believer over the last 6 or 7 years that rates would stay very low. And so, I can't tell you how many meetings, every meeting, every business meeting I go to and have gone to since 2009, every conference that I've spoken at and attended, the conversation has been consistently around the question, when will rates rise and how high will they go?
Right.
And it's fear of the boogeyman that never came. And I've been saying this for 6 or so years, that 7 years, that this is the wrong question, and that investors, by asking the wrong question, are actually investing incorrectly. So if you had believed for the last 6 or 7 years that there's a significant risk of a significant rate increase just around the corner, you would have invested incorrectly for the last 6 or 7 years. And I think the right question here is, what happens if rates don't rise at all for the next decade or two? That would be the right question. And I think that's the more likely outcome here. I think that there's there's enough reason to fear that and to be investing according to that forecast, and I'll tell you why. What we saw happen in the crisis in 2009, we went through the looking glass of finance. So everyone like me and older than me never dreamed that quantitative easing would be possible, like the literal manufacturing of currency, okay, out of thin air. That was something that nobody even anticipated. So most of us that had the most experience were quite bearish in 2009. I think that we mostly, if you look at who missed the rally in financial assets since 2009, it was a lot of the most sophisticated investors. Seth Klarman, who runs probably historically the most successful large hedge fund in the world, has been sitting on 30 or more % cash for the last 7 years. So here's a guy who's, I think, rightly identified as one of the true geniuses in the investment world, missed the rally. And the reason he missed the rally is because he, like most people, never imagined that there'd be quantitative easing. It was something that no one ever dreamed of. But now that we've gone through that looking glass, and now we know that the Fed can literally manufacture, and central banks around the world can manufacture money out of thin air to boost asset values by depressing interest rates. We know that that exists, that power exists, and it's been used. And it's been used in a very significant way. I mean, the Fed balance sheet in the crisis has grown from $750 billion to nearly $4 trillion. So that's massive growth in Fed balance sheet, and no one notices and no one says it's a problem. It's not even talked about. So why, if a Fed balance sheet can grow that much from under $1 trillion to $4 trillion, why couldn't it grow to $8 trillion or $12 trillion? And who's going to stop that, right? So I think we are in a period of time where the governments of the world are facing levels of indebtedness, both on a governmental level, on a financial services level, and on a household level. And that includes China, Japan, Europe, and ourselves. That I think it's almost inconceivable that they wouldn't use everything in their power to continue to suppress interest rates in order to kind of not allow the historic debt levels to completely squash economies around the world. So I think we're in for a very low interest rate environment for a very long time.
Yeah, that's you touched on some very major points there. One of the things you mentioned is that if you anticipated interest rates rising, you would have been investing incorrectly, given the nature of what has taken place so far. Can you give us an example of, kind of the different strategies that you would be implementing based on what you just kind of outlined there?
Well, I mean, I remember sitting in my brother's office. My brother is a real estate investor. And he has a firm that manages money, his own and investors. And they do a variety of things. But in the end, it's about owning real estate. And I'm going to go back now probably to 2013. And I remember sitting in his office and him basically, like many, many very smart people, thinking that this silliness cannot go on and that there has to be a major correction and we have to be near a top, and shouldn't he just sell everything? And I said to him, Joe, I understand why you're thinking that. It's all logical. But if you look around the world at the imbalance of capital that is seeking to be invested and the paucity of investments and even the greater paucity of yields, there's the kind of search for safety from foreign investors and the availability of safety in very few investments better than U.S. real estate. One can make a very legitimate case. In 2013, I said that cap rates can go significantly lower. And he couldn't believe me, and it turned out I was right. Not that I'm a genius, but I just looked at those variables. I mean, my particular expertise has been in playing in the world's capital markets and understanding how capital flows work. And and understanding that those really, the capital flows of the world ultimately dominate price action for assets. So if you had sold things in 2013, rather than wait to 2017, you would have missed a significant portion of appreciation that you could have enjoyed.
Yeah, absolutely. And a lot of real estate investors that I was, working with at the time too, were very concerned. 2013, a lot of people started moving out of the more traditional asset classes because of the cap rate compression, and it's really, done nothing but continue to compress since then, and in the markets that were most desirable at that time as well. So do you think
Well,
that...
I think that, Hunter, I would tell you this too, that I think that I've seen this in numerous cycles. And whenever the rules change, I would say the rules change. Whenever the rules change and we kind of see things that we've never seen before, it's the smartest, most experienced people who have always succeeded based on historical rules that get it wrong. And so I guess I always try to tell people, don't be so preoccupied. Be aware of historical trends and pricing, but focus on the moment. Understand that today is a new day, and it may not be like past days, and therefore cycles are not going to repeat themselves quite the same.
Do you think that negative interest rates are a possibility in the United States?
Well, I think that everything is possible. And I think that not only negative interest rates, I'll tell you what I think is even more likely than negative interest rates. I think that if you want to hear something that you're not going to hear from too many people, I think there may come a day when the government literally sends envelopes with cash or checks to people, which is effectively negative interest rates, but in a different way.
Right.
I think there's such a deeply rooted and completely wrong-headed belief that the government can stimulate the economy by stimulating consumer spending. And I think that stupid belief has caused a lot of problems that ail the world today and could easily lead to what I said before, just sending people money in the hope that they'll spend it. And maybe they'll send them vouchers so they actually have to spend it,
right,
believing that that would stimulate some sort of economic vibrancy. So I can imagine that, which, as I said, is really a form of negative interest rate. You're basically paying people.
Right. Paying people to have the money, basically.
To do nothing. Exactly.
Right. So that's a really interesting perspective. I mean, from an investment perspective, this idea that this money is going to keep coming to some extent, basically indefinitely, when that happens, obviously people continue to chase yield, and a lot of people continue to move 1-2 rungs into the riskier strategies of investing. Talk a little bit about, how if you're seeing that in the market, if you think that that's, appropriate in certain circumstances. What are your thoughts on kind of leveraging up and, moving up in risk to kind of accommodate for that?
Let's talk about that in a second. But before we leave the issue of rates high, rates low, I ask people to also think about, like, why do we get high rates? Like, what precipitates high rates, and what do high rates achieve versus why are rates low and what do low rates achieve? And then when you start asking those questions, you can start to analyze kind of the likely outcome. The other thing I would say is and when I speak publicly, I do this, I would tell every one of your listeners, you can get it if you Google it. Go Google the 100-year history of 10-year U.S. Treasury rates and print it out and stare at it. And that is one of the most telling and informative charts. It explains so much about the past, and it gives you the potential for such great insights going forward. I happen to find like you can literally spend a day staring at that chart and learning things from it. And I think I could write a very big book on kind of realizations and lessons learned from that chart. But I'll tell you one thing about that chart. What people don't know is that we tend to think short term. So, in my career, which has been 35 years, the average U.S. Treasury 10-year yield has been, I don't know exactly, but I'm going to guess it's in the neighborhood of between 6 and 7%. And so in my mind, that's a normal, right? And so the question, if you believe that, is like, okay, well, we're now closer to 2% or 3%. When are we going to 6 or 7, right? And boy, what's that going to be like?
Right.
But if you look back 100 years, what you'll see is that for the entire time until about 1972 or 73, the 10-year Treasury hovered between 2 and 4%. There were 2 outbreaks, and it broke up towards 5%. So the average was probably close to 3%. The extreme high was 5, and that only happened twice, and most of the other time was between 2 and 4. Then something happened in the early 1970s that economists still haven't gotten their arms around in understanding. But rates soared. So from 1973 or 4 to 1983, the 10-year Treasury rocketed up towards, I want to say 14 or maybe even higher percent. I don't remember exactly. It might have been 16%. It was a crazy number. And that peaked in 1983, which is kind of 82, 83 was my first year in the business world. And then from there, there's just been this steady reduction in interest rates that has fueled the entire, you could blame or credit that decline in rates over the last 35 years. You can credit that with everything good that you can credit. Asset value appreciation, stock markets, real estate, the money management, the finance industry, it's all attributable, private equity, everything, to that story. Like everyone's success is to a large extent directly related to that amazing and historic decline in rates from a historically weird acceleration in rates in the period of time leading up to 83. So that's the aberration. The aberration is not 2 to 4%. That's the normal. The aberration was the weird spike leading up to 83, and then this steady decline since 83. But we're now where historical normal 10-year yields are at Treasuries. The other thing is we're still much higher than countries that are far less safe than us. So one might ask, why is the German 10-year Treasury rate or the Japanese 10-year Treasury rate lower than ours? Doesn't really make a lot of sense. So I still think that, again, for all these reasons, I think rates are likely to remain low for quite some time. Now, getting to your other question about risk, it's surely kind of, the dark side of an ultra-low rate environment, especially with the memory of higher yields pervasive in our society, right? So most investment professionals weren't alive and active in the mid and early 1900s. Okay, so their experience and expectations are informed by the period of time from 1975 till now, and that period of time was a period of high yield on a relative and historic basis. And so people, if you go and you say, if you talk to the average investor, institutional or individual, and you ask them, what are you looking for in yields? Well, most of them would say double digit, and quite a few would be talking in the high teens and perhaps even 20% expectations for returns on things like real estate or investment, private equity and such. Now that, by historical standards, is crazy, and when compared to Treasury yields, is crazy. So in in a world where treasury rates are 6, 7, 8, 10%, maybe 15 to 20% for these other things make some sense.
Mm-hmm.
But in a world where treasury rates are 2 to 3%, it can't really make sense. And so I think that people are still of the mindset. Many have not changed their mindset. Many still want to hear promises of yields that are probably not achievable. And there are managers willing to say whatever they need to say to attract that capital and charge fees on it. It's one of the nice things about our fee structure. We don't get paid to manage money. We get paid to succeed in our investment strategy and delivering the returns we deliver. I think people should be very cautious about believing lofty projections from managers who charge fees, because they'll say anything to get the money under management and then charge fees on it. And the longer the lockup and the longer the kind of come to Jesus. So if you're a private equity investor, you may have a 10-year lockup and an 8 to 10-year investment horizon. Investors will have paid 1.5 or 2 points in fees for 8 to 10 years before they find out that they're going to be disappointed on their returns. And there's no way out. So I think that there's a lot of warning labels that should go on many, many, many investment funds and investment strategies today, warnings that you're not likely to get the returns that you're hoping for or that you might have been promised. I think that's just not available in the world today.
Absolutely. Very interesting. And that's actually a great segue into something that I saw a blog post. You mentioned the financial super cycle, and you mentioned the evolution of investment vehicles that have popped up over the years, like the creative loan products and most notably subprime 2008. Are you seeing any new loan products or similar creative quote, financing models that could continue to inflate prices or keep them, inflated even more so than they currently are?
Here's the thing about all this stuff, right? There's two things, and they're directly tied to manipulating asset values. Low rates, we talked about that before, and debt. So if you and I were in charge of the United States financial system, we would want to hold the lever of control on those two things: availability of debt and the cost of debt, which is interest rates. And if we wanted to goose valuations of financial assets and create the illusion of economic prosperity, we would manipulate rates low, and we would make sure that there was a fairly abundant availability of debt funds for people to borrow at those low rates. If we wanted to moderate values and manipulate them lower, we would do the opposite. We would manipulate rates higher, and we would constrain the availability of debt. What do you think government generally wants to do?
Inflate. Keep prices high.
I always say that it's very, very hard for an incumbent to get reelected when people's house value has declined.
Yeah.
Right? So it is the politicians' desire to be reelected first and foremost. And they understand that when people feel richer, their stock portfolio is worth more, their home is worth more, then they're happier. And when they're happier, they're likely to vote incumbent. When they're not happy and they're nervous and they're feeling financially insecure because their stock portfolio is worth less and their home is worth less, they're likely to vote the incumbents out. And it's the incumbents, the people in politics, that have the power over those two important levers that we spoke of. So, sometimes the market gets away from the control, but generally speaking, and that's why you see cyclical corrections so quickly, right? 08, 09 was a disaster. We were staring into a complete black hole. But those in charge figured out how to gain control of those two levers. and reinflate asset values and make everyone vote incumbent again or calm again. And they did it in ways that perhaps were unprecedented, but they were the same basic two things: rates low, abundance of capital to borrow available. And so that's kind of answers your question, I think.
Yeah, absolutely. And there's just a million different ways we could take that conversation to go.
By the way, it's why, Warren Buffett is perceived to be so smart. But you know why he's smart? His smarts come down to understanding what I just said. That how he always says, I believe in America. I believe in the long term of America. I mean, it sounds very patriotic and it sounds really folksy for a guy from Iowa. But in the end, he believes in politicians' commitment to get reelected. And he understands what I just said before, that no matter how bad asset values might get in a downturn when things get away from politicians, they will find a way to grab those two levers and reinflate. They always have, and they always will. That's when he says, I believe in America, that's what he means.
That's pretty heavy. So, from your perspective, how loose or tight would you say capital markets are right now in the commercial residential markets?
Well, they're certainly not tight, okay? So I think commercial real estate borrowers have a pretty good environment today. I think that you could, with the exception of the niche that we're filling, which is construction and land development, which is, I think, pretty tight. But other than that, you could borrow at historical rates and pretty high leverage levels. When you get to residential or single family, what I'll call consumer finance, I think that it's still pretty good. Rates are still obviously extremely low. I think that there are some legacy holdover restrictions that were put in place after the subprime crisis to protect consumers from predatory lenders that have somehow stifled access for, I don't know, some percentage of would-be borrowers to debt capital. But I have great faith in politicians liberalizing that and reversing that over the next year or two.
Got it. Are there any real estate investments that you're currently bearish on that you completely stay away from?
Yeah. Oh, I do think even in this very benign environment that I've portrayed, where I believe rates are likely to remain low for a very long time, doesn't mean people won't lose money. And the reason people will lose money is because I think economic vibrancy is also likely to remain very low. And I also think we're in a period of time when generational changes in tastes and behavior patterns are going to kind of make certain pieces of real estate more or less valuable. So I always say, look, I was probably the last generation of people who, as a kid, dreamed of a career on Park Avenue in Manhattan and wearing a suit and tie. Young kids today, that's not their dream, okay? They never had that dream. They never went to business school and dreamed of wearing a suit and tie and going to work on Park Avenue in Manhattan. So Park Avenue buildings are in trouble, I think. I don't think those are good long-term investments because I think the generations coming on now and over the next 50 years, for them, it doesn't have the same appeal that it did for prior generations. And so that's just one example. We all know the retail story about how retail tastes are changing, right? Nobody young today is proud to say they shop at Sears, which is why Sears is having trouble, right? Or Macy's, or other kind of historic names that generations prior actually did enjoy and look forward to go shopping at. So we're in a very interesting generational change of taste and behavior patterns that are going to have profound effects on real estate and cause, even in a benign interest rate environment, cause losers and winners. That's exciting. It creates opportunity.
Absolutely. Are there any cities, any markets that you're staying away from or that you're very interested in?
Well, it doesn't take a genius to kind of know that cities that have certain characteristics make them better, safer places to be for real estate investments. And those characteristics are educated population, which brings about better job security and job opportunities, which kind of self-fulfills, right? And it trickles through every sector of real estate. So the Seattles, the San Franciscos, the LAs, the San Diegos, the bigger cities kind of continue to be safer places. But I always say to people, there's opportunity in every city in this country. The real estate in the end is the most local business. There is no such thing as a national real estate industry, right? I use the example of an office building in Century City in LA has literally nothing in common with an apartment in Jacksonville, Florida. And yet they're both real estate in America, right? And they both could be wonderful or terrible deals. So, you have to look, real estate it defies grouping in that sense. And that's what makes it fun and opportune.
Right. And so those cities that you mentioned, the Seattles, the LAs, the San Franciscos, are those cities usually, in that list regardless of market conditions, or is that based on current market conditions?
Well, I think that I have a term that I've coined over my career called viable real estate. Viable real estate means real estate for which there is proven demand. So it makes it safer, right? If you wanted to spec build an office building in Century City, LA, there's other office buildings here and there's been a history of office use. It's not speculative. If you wanted to put in a Four Seasons hotel in Riverside, California, because you think that there's an unmet need for a high-end, full-service, 5-star hotel with room service 24 hours a day in Riverside, and no one's ever built that before, but you just believe it's needed, well, that would be perhaps an example of a piece of real estate that once you built it, you would find out it's actually not viable. It should never have been built in the first place.
Right.
It may be worth nothing, okay?
Yeah.
So places like New York and San Francisco and Seattle, LA, they're chock full of viable real estate, right? You could pretty much put a blindfold, throw a dart at the map in those cities, and you'll hit viable real estate. When you go to a city like Buffalo, it's not that way. There is viable real estate. There are certain locations that have always attracted and will continue to attract human beings. That's what makes it viable. But in Buffalo, there's probably, if you threw a dart at a map of Buffalo with your eyes closed or blindfolded, you're more likely to hit unviable real estate where nothing should be built. Okay.
Interesting. Yeah, interesting. And so, obviously we look for a lot of cash flow investments. And so it's challenging to get cash flow in those cities. How does the predictability of cash flow weigh in on your factor when you mentioned some of the markets where, if you're buying for cash flow, you're going to get, sub 7, even levered. What are some of your thoughts on that? Like how cash flow plays into that conversation?
Well, here's the thing. I started my career as a bond trader, trading mortgage-backed securities at Drexel, and there was a famous bond floor saying, which is that there's no such thing as bad bonds, just bad prices. And so that really applies to what you're suggesting, very highly priced real estate. So viable real estate in the cities that are the ones everybody obviously prefers for safety reasons has now been bid up to prices that make their safety questionable, right? If you buy something at too high a price, then your downside is now greater because any correction, disappointment, it may be priced to perfection, right? If rents don't grow, but instead just stabilize and maybe even go down a little bit, or occupancy goes down a little bit, then you're not going to be very happy, even if you bought a beautiful piece of viable real estate in one of those cities. So price is a very important consideration when determining whether it was a good buy or not. Viable is one test, but price for that viability or safety is another. And this is a conundrum for investors today.
Right. Yeah, exactly. It's something we deal with every single day. With that in mind, where do you think the most opportunity is right now for young real estate entrepreneurs that are just getting started and looking for an opportunity in real estate?
Well, I am now a bit older and more experienced and have been a young entrepreneur, and now I'm an older entrepreneur. And I've learned many lessons. And one of them is, this sounds so trite to say, and I never really liked it when I heard it when I was younger, but it's really true. Remember a couple things. One, that your life is not a sprint. It really is a marathon. And the joys of your career are much more the journey than the outcome. So, anything you do, putting one step in front of the other and just doing stuff is really important. You're learning every step. You're learning in every action, whether it's the right or wrong. So I see young people today sometimes preoccupied with, is this the right job for me? And I always tell them, it's a job, do it. And just bring your best. And it doesn't matter what you do. If you're a leasing broker, tenant rep, sales broker, analyst, acquisition analyst, property manager, attorney for closings on deals, it doesn't matter, right? These are all fine places to learn and grow. If you're an entrepreneur, you'll find that out because you'll be the one that'll take the knowledge that you're going to gain from any of those jobs, and you'll figure out ways to actually be entrepreneurial. If you're not, you won't. And it doesn't matter. You'll be who you're supposed to be, and there's no shame in that. If your destiny is to be a great property manager for the rest of your life, fine. That's something to be proud of. Just do something, do everything great, and do things. Always do things. Don't overthink. And don't be in a rush.
I love it. I actually think that's a great note to end it on. Ethen, I can't thank you enough. Just really enjoyed the interview. Thank you so much for your time.
My pleasure.
For all the listeners out there, thanks again for taking the time to listen to this episode. I hope you enjoyed it. If you did, please do take the 30 seconds it takes to get on the iTunes store, find us, and leave us a positive review. It makes a significant difference and encourages new guests to come onto the program, quality guests like Ethen. Now, if you want to get in touch with Ethen, please go to mosaicrei.com. That's MOSAICREI.com and go to their contact form. You can also find Ethen's blog at Ethen Penner, mcap.blogspot.com. Ethen Penner, mcap.blogspot.com. All of these links will be in the show notes page as well. Thanks again.